We proceed on to the next variance, which is the direct labor cost variances. Again, just like the material cost variances, the labor cost variances are three. The main one is the direct labor total variance, and you have the two other variances, the direct labor rate variance, as you can see in the notes, and the direct labor efficiency variance. So the direct labor total variance is actually the standard cost of actual output and the actual cost in terms of labor. And all total variances are ideally computed in the same way. It is what actual output should have cost and what actual output did cost in terms of that particular cost element. So in our case, it is labor. So the direct labor rate variance is computed just like the material price variance, and it actually depends on the hours that were used in the production. So we look at the standard cost of those hours and the actual cost of the hours, and we get the difference. So that is the rate variance. So it's a variance on the applicable rate for your actual hours and what you had planned for. So the actual hours, you had the budgeted rate per hour, then you have the actual rate per hour, and that difference gives you the rate variance. So it is computed the same way as the material price variance. The other variance is the labor efficiency variance. And the labor efficiency variance is also computed the same way, just like the material usage variance. The labor efficiency variance actually is what actual output should have used in terms of labor hours and what actual output actively used, and I stress that word actively. Then that difference, the standard hours of actual output and the actively used hours to produce that output, the difference is multiplied by the standard rate per labor hour. And that gives us the labor efficiency variance. So the labor efficiency variance, it measures how efficient workers were to produce that output. Did they use more hours than the planned hours? Did they use less hours than the planned hours? If they did use less hours, then we talk about workers being efficient. If they used more hours than the planned hours, then the workers were not efficient. Lastly, about labor, there is the idle time variance. Now, you find that out of the total hours that were paid for by an organization, not all those hours were actually effectively utilized. There are some hours where no production was taking place, and those were the non-active hours. And even if the total number of hours would end up being paid for, the actively used hours will be less than the total hours, and that breeds the idle time variance. So the idle time variance is about those hours the workers were not actively working, and yet they were paid for. And the idle time variance is always adverse. So in terms of these variances, when you have a favorable variance, it is, if in terms of cost, then the cost incurred was less than the expected cost. If the variance was adverse, then it means in terms of cost, you incurred more cost than you actually planned for. So we have a practice question here, which I want us to go through and compute the labor variances. And I want to read the question as you can see it. The standard direct labor cost of product X is as follows. 2 hours of grade Z labor at Kenyan shillings 5 per hour, which is 10 shillings per unit of product X. During period 4, 1,000 units of product X were made and the direct labor cost of grade Z was 8,900 shillings for 2,300 hours of work. We are supposed to compute the direct labor cost variances. So we find out what will be the total variance first, because total variance will be the first one for us to compute. And according to this question, we need to know what the output of 1,000 units should have cost in terms of labor, and what that output actually ended up costing in terms of labor. According to the standard cost card that I can see here, every unit should have used 2 hours of grade Z labor, and that should have cost 5 shillings per hour, and that should be 10 shillings per unit. So 1,000 units should have cost 10, and that should be 10,000 shillings. But the actual cost for labor was actually 8,900 shillings, and that gives us our labor variance, which is 1,100, which is favorable. And why is it favorable? Because we expected the 1,000 units to cost 10,000, but the 1,000 units have ended up costing less, 8,100, so we have actually saved in terms of labor. The next one is the labor rate variance. We want to find out the hours which we have incurred in this scenario. What should have been the actual, the standard cost, and what was the actual cost? We have incurred 2,300 hours of labor, and every hour should have cost 5 shillings per hour. So, but ended up costing 8,900. So it appears we were expecting about 11,500 shillings of cost of labor cost, but the cost was actually 8,900, which is less by 2,600. And that means that the direct labor rate variance is actually 2,600, and it is favorable. Favorable because the variance is actually less, the actual cost is less than the standard cost. We proceed on with the efficiency variance, and with regard to the efficiency variance, we are measuring how efficient we have been in producing the 1,000 units. Our plan was to spend 2 hours for every unit. We were expecting about 2,000 hours of labor, but we ended up using 2,300 hours of labor. What that means is we have used more hours of labor by 300 hours, and that means we are not efficient, and that means our efficiency variance will be adverse. So we have 300 adverse hours, which we are going to multiply by 5 shillings per hour, and that gives us 1,500 shillings adverse. That means we can now do a reconciliation, and by the way, in this particular question, there is no idle time mentioned, so we are only going to compute those 3 variances. And we can do a reconciliation to see whether our variances that we have computed actually reconciles. So we have 1,100 favorable labor cost variance, and the other 2 variances, the subdivision of it, we have 2,600 favorable and we have 1,500 adverse. So if you take 2,600 favorable and 1,500 adverse, you add, you get the total variance of 1,100, which is favorable. We will also look at this practice question 2, which is also about labor. And in this particular question, we will see the concept of idle time. And I read the question. 2 hours of grade Z at Kenyan shillings 5 per hour equals to 10 shillings per unit of product X. During period 5, 1,500 units of product X were made, and the cost of grade Z labor was Kenyan shilling 17,500 for 30/80 hours. During the period, however, there is a shortage of customers' orders, and 100 hours were recorded as idle time. You are required to compute the variances, and in our case, we compute the total labor variance, the rate variance, the efficiency variance, and the idle time variance. So we begin with the total variance, which you can see the computation done on your screen. The total labor variance is about how many hours, how much the actual output of 1,500 units should have cost. Every unit should have cost 10 shillings, but ended up costing 17,500. So we were expecting 15,000 shillings as standard cost of labor, and we actually ended up spending 17,500. That gives us an adverse labor cost variance of 2,500. The labor rate variance is about the standard cost of our hours, which we used, 30/80 hours. And in terms of the rate, we are going to pay for all the hours. We're going to pay for all the hours that we have spent, including the idle time hours. So 30/80 hours should have cost 5 shillings per hour. That should have been about 15,400, but we ended up spending 17,500 shillings. And that means our rate variance is actually an adverse variance. We actually ended up spending more in terms of the payment of the hours that was spent, 2,100 adverse. Next, it should be the efficiency variance. We want to see when we produce these 1,500 units, were we efficient or are we not, in terms of the consumption of hours. So the 1,500 units should have used 2 hours each, that is 3,000 hours. But in terms of active hours, we spent 2,980 hours. 2,980 because out of the 30/80 hours, 100 were recorded as idle time, and therefore the actively used hours were 2,980 hours. That means we expected to spend about 3,000 hours, but we ended up spending 2,980 hours, and therefore we have had a favorable variance of 20 hours. Then we multiply that with the standard rate per hour, which is actually 5, and we get 100 shillings favorable variance. That means the efficiency variance is favorable. We have actually spent less hours than we should have spent under normal circumstances, under planned circumstances. Also, we have some 100 hours which have been recorded as idle, and that means for the 100 hours, we paid them, and therefore the workers were paid, and that yields an adverse variance. So every hour will be multiplied by 5 shillings to give us 500 shillings, and it is adverse. It is important to do a reconciliation of these variances, and as you do the reconciliation, we have to know that the total variance should be equal to all these subdivisions, the rate variance, the efficiency variance, as well as the idle time variance. Let's check whether our workings will reconcile. We're going to add from idle time 500 adverse. We add efficiency variance 100 favorable. That gives us 400 adverse. We add the rate variance of 2,100 adverse. That will give us 2,500 adverse. And that is the labor total variance. So far, we have looked at 2 variances. We have looked at the material cost variances and labor cost variances. Our next session will be to look at the variable production overhead cost variances and the fixed production overhead cost variances.